let's talk about some of the bigger picture categories that we can be investing our money in. And there are a lot of different ways that we can invest. And obviously inside of the retirement plan that's sponsored by your company, we've kind of limited some of the choices that you have to some degree for your own protection, to make sure that we're not giving you options that can go dramatically down very quickly and you can lose larger portions. We want to give you kind of bigger picture options that don't have quite as dramatic of risk potential with them. But as you look at this chart here, this chart shows you the major categories that you can invest your money in. And so you see here back in 2000, commodities was the best performing category. So you can think of some different commodities that are out there. Oranges, commodities like different products, agricultural products, as well as some natural resources that are out there. REITs, real estate investment trusts, so commercial real estate, not residential real estate, in 2000 returned 26.4%. Fixed income or bonds returned 11% back in 2000. Cash, which right now, as we said, cash is really paying zero, returned 6% back in 2000. Then high yield bonds, so a little bit riskier bonds. We're going to skip over this white category for a second. Small cap companies, so today this equates to WebMD and Shake Shack. Large cap companies in the U.S., large cap or kind of mainstream international companies in Europe and Australia and Japan, and then emerging markets lost 30% in the year 2000. So those companies that I mentioned in countries like Brazil, Russia, China, and India. And so again, you can see the spectrum in 2000 was pretty wide. In one category of assets, I returned 30% in 2000, and in another category, emerging markets, I lost 30%. And then everything else kind of fell in between that. And so my question to you all, as you look at this and you trend it out over the last 15 years, is which of these categories do you think was the front runner or performed the best in 2015? Let's see some guesses. And you can just write in colors if you want, if that's easier for you. Okay, so I see a guess for large cap. Purple. Okay, so REITs. They're clarifying light purple. So emerging markets. Small cap. Cash. High yield. So we people have pretty much answered every single category that's out there. You can see what actually happened last year. REITs did lead the way again, followed by large cap. But then right behind that was bonds and cash. So again, we really didn't see a whole lot of growth in the market last year. And we see some of these more conservative vehicles actually perform pretty well relative to kind of what else we saw. Emerging markets down 14%, commodities down almost 25%. So I think the answer, as you think about that question as to which category is the best, that's a very difficult question to answer. And I think it's critical that we understand how do we spread our money out into a lot of these different categories. And that's what we see represented by the white box, which is an asset allocation model, which is holding a lot of these different categories. And many of you have access to these type of models and target date funds where you are getting some exposure to all of these different categories inside of one single investment that's being automatically rebalanced for you on a systematic basis. So again, just to kind of magnify or show you the roller coaster ride of some of these categories. Here's small cap in orange. You can see the up, down, up, down, up, down. Here is emerging markets. So you can see some pretty dramatic down years, down 53% in 2008, down 18% in 2011, and down 30% we already mentioned. And then here's bonds, fixed income. So even though, again, we're not going to see dramatic losses, dramatic negative numbers in bonds, we are going to see that there's years where bonds are one of the lower performing categories. So again, we got to take that into account as we're building our portfolio. And the goal here really is to, as you see on the screen here, we want to spread our money out. We want to allocate our money into different asset classes we really want to just try to avoid striking out. And as we said before, with kind of the blockbuster scenario, we don't want to lose, dramatic portions of our portfolio, because the reality is if I lose 50% of my money and then I gain 50% of my money, I'm not back to zero. Think about that for a second. If I've got $100 and I invest and I lose $50, or lose 50%, I'm down to $50. I gain 50%. Common sense kind of tells you I'm back to 100 where I started, but if you really do the math there, you're only back up to $75. And the same thing happens if my $100 gains 50% in a year and then it loses 50% the next year. I'm up to 150 and then I'm down to 75. So again, we've got to avoid the strikeout and the big loss. And I think it's worth giving up the home run or giving up a lot of home runs, and to use that baseball analogy, to simply just hit a lot of singles, hit a lot of doubles. Let's just kind of try to get normal and good kind of single-digit returns year over year to help us grow this money over time. Let's hear from you all. The companies that I'm putting on the screen here, what do they all have in common? Okay, good. I see somebody wrote it there, and I see a couple different answers here, but the one that I was looking for is they're international. All of these companies are owned or based by entities that are outside of the U.S. Even the king of beers, America's beer, if you will, is owned by InBev, is owned outside of the U.S. So again, I think that there are a lot of companies that we use and we trust and we're spending money on, and they're not American-based companies. So I think we've got to recognize that when it comes to how we're investing our money outside of the U.S. and making sure that we are taking advantage of some of these opportunities that exist for us to grow our money in a positive direction. Let me give you some perspective on kind of how the equivalent indexes of other nations have done. So we look at 2005, the U.S. of this group of 6. So just to make sure we all know these companies or these countries, Russia performed 73%. Their index performed 73% in 2005. Brazil was up 56%. Japan up 25%. China 19, and Germany 9 or 9.9. And the U.S. was last that year of this group at 5.1%. And then we see what happened in 2007, 2009, 11. U.S. is now the top of the charts, but that's really not because they blew it out of the water. We only returned 1.4% in 2011. It was really that other nations went down pretty dramatically that year. 2013, the U.S. led again, just barely over Germany and Japan for that matter. And you can see some of the losses now that Brazil had suffered in those years versus some of these tremendous years in growth that they had seen there. And then what about 2015? What do you all think? Which country performed the highest in 2015? You guys see somebody US? Somebody else Germany? Not Russia, somebody said. Okay. So let's see what happened. So actually Japan